Hello everyone and welcome back to a new video. As always, if you enjoy the content, make sure to leave a like and subscribe. So what I'm going to be doing in today's video, as you guys saw by the title of it, is going into detailed explanation as to what exactly are options, what does it mean when you buy an option, and what does it mean when you sell an option. And the reason why I'm going to go do this is because I've been getting a lot of comments and messages on Discord to basically explain what the two mean when you buy an option or sell an option as an opening trade, because once you start getting into more complex strategies and options, it starts getting a little bit confusing, especially if you don't have a good understanding of how options work. So I'm going to split this video into two parts. The first part, I'm going to explain the differences between buying and selling an option as an opening trade. And then the second part, I'm going to go into detail explaining what exactly causes an option price to fluctuate. So basically explaining the Greeks and what an in the money and out the money option means. So for today's video, I'll be using Apple as an example just because it's a very well-known company. So what you want to go ahead and do is open up the options chain. I'm using Robinhood because that's just the brokerage I have. If you have a different one, it might look a little bit different, but just go ahead and find the options chain. So when you open the options chain, what you're going to see is a bunch of prices and numbers, and if it's your first time seeing this, it might seem a little bit intimidating, but trust me, once you get the hang of it and good understanding, it really isn't that hard to understand. But like I said, when we go ahead and open the option chain, what we see is always set to buy and call, and this is on Robinhood. On other brokerages, you just see this right here, the buy and call. So basically, like I said, it's set to buy and call. So there's two types of options, either a call or a put. And when you're buying an option, a call means that you believe the stock price is going to go higher, and a put option means that you believe the stock price is going to go lower. But that's only when you buy an option. Remember that. The key here is buying. So for example, let's say right now Apple's trading at 319. So let's say that by next Friday we think Apple's going to be above 320. So if we were to just buy 100 shares of Apple, because when you buy an option, that's what you're controlling, 100 shares of a stock. So if we were just to buy 100 shares of Apple, it would cost us $32,000, which is a lot of money. Maybe you don't have that money, or maybe you're not willing to put that much money into a single trade, but whatever reason, most of us are not going to want to put $32,000 on a single trade. So what we can do is go to the options market. So right here we see this option of 320, and this is the strike price, 320. And so it's currently trading at 343. But like I said, each option is 100 shares of the stock, so that's actually $345. So we would be able to control 100 shares of Apple for just $345 instead of outright buying 100 shares of Apple, which would cost us close to $32,000. So you can see the huge price difference, which would actually help us benefit a lot more, and this is why you can get really high returns on options. But like I said, when you buy a call option, you essentially want the stock price to go up. So the way we would make money on this option is if the stock price goes above 320, then we would be making money. The further it gets below 320, then we would be losing money. But our max loss would just be 345 because that's how much we paid for the option. So essentially, remember this. When you're buying an option, you're paying a debit because you're paying for the option. You're not the option seller. And I'll get into a little bit more explanation what an option seller is later on in the video. But that's pretty much it for a call option. So now let's go ahead and look at the opposite trade, a put option. So a put option basically means that you want the stock price to go down. You think it's going to go lower. So what can you do? It's basically the same principle as a call. If you just want to short Apple, it would cost a lot more. It would cost close to, like I said, $32,000. But let's say, we think Apple's going to be heading lower. And let's say that we think it's going to be going all the way as low as 315. So we'd go ahead and click on the 315 strike, click the add, and then we would be able to buy that. And so, let me go ahead and close this call right here. So right here you see it's $2.56, but like I said, it's 100 shares, so it's actually $256. So we'd be able to control 100 shares of Apple at 315 for a total of $256. So if the option price goes down, then we would make money. If the option or if the stock price ends up going higher, we would be losing money, but the max loss that we can assume is $256 because that's what we paid for the option. So essentially, when you're buying options, a call means that you want the stock to go higher, and a put means you want the stock to go lower. So now that we got the buying portion out of the way, I will explain to you what it means when you sell an option as an opening trade. So when you sell an option, it's basically the opposite. So that might seem a little bit confusing at first, but once you get the hang of it, it really isn't. So like I said, when you sell an option as an opening trade, it's the opposite. So a call, instead of the stock going higher, you want the stock to go lower when you sell a call. And same thing for a put. Instead of going lower, you want the stock to go higher. So let's use an example. So let's say we want to sell the 315 call. Let's use this 315 or the 315 put again. So essentially what happens when you sell a call or a put? We go ahead and here you can see that if you go ahead right here, there's a negative right there, a negative 256. So what exactly does that negative mean? So when you're selling options, you're basically becoming the market maker. So you're creating the contract. So by creating the contract, you're going to get the debit that the other person is paying for the contract. So essentially, you're going to receive a credit of $256 instead of having to pay $256 for the trade. So this is the guaranteed profit that you're going to get, $256 for selling this option. So like I said, if you're selling a put, you want the stock to go higher because that means you're not going to have to buy the stock at $315. So let's say by the end of Friday next week, Apple is trading around the same price right now, $319. So this option would expire worthless. So when you're selling an option, you actually want the price of an option to expire worthless because that means you get to keep the full premium and not have to pay any assignment because you're not going to be able to get assigned because they're out of the money. But what would happen if Apple is below 315? Let's say Apple ends at 314. So that means that the 315 option that you sold would be considered in the money and you would get exercised and assigned. So essentially, you still get to keep the $256, but now you're also going to have to buy 100 shares of Apple at 315. Don't worry about it. If you want to do this, you're going to have enough collateral to be able to have 100 shares of Apple. So Robinhood and your broker wouldn't let you enter this trade unless you have enough money to cover the assignment. So it normally works on better on stocks that are lower priced. You guys go ahead and watch my previous video. I go into an explanation of how I'm selling options on Wells Fargo, but that's pretty much it for option selling. So it's the same principle for call. You know, when you sell a call, you have to have the collateral of the shares in order to sell the call. But let's say we're going to use the 325 example again, and let's say we sell this option right here at the 325. If we go ahead and click plus, we see that there's also a negative right there. So what does the negative mean? Like I said before, it just means you're getting the credit because you're essentially getting $156 for becoming this option seller. And so if the price of Apple is below 325, that means you're going to get to keep the $156 dollars that you gained for entering the position, and you don't have to sell 100 shares of Apple at 325. But let's say Apple ends up at 326, so then this option that you sold would be considered in the money, and you would be assigned and have to sell 100 shares of Apple at 325. So now that you know what the difference is between buying and selling an option as an opening trade, what exactly is the best strategy to use and when should you use each strategy? So if you guys have seen my videos for a while, you will know that I am a really big fan of selling options just because it's a lot more profitable in the long run, and I'll go into explanation in a different video as to why it's more profitable. But let's say you want to buy options just because the return on them is a lot better. When is it better to buy options versus when is it better to sell options? So the way we use and calculate the overall prices of options and determining whether it's a good buying opportunity or is it a good selling opportunity is using implied volatility. So implied volatility basically measures how much is a measure of how much the stock has been moving in the near term future, and a good tool to kind of calculate whether option prices in general are cheap or high is something called the VIX. So the VIX is known as the fear gauge, but basically what it just does, it just tracks volatility. And more specifically, it tracks the volatility of options of the S&P 500 index. And basically, when the VIX rises, that means option volatility is rising, and that usually means that option prices are going to be rising, and vice versa. When the VIX drops, that means implied volatility is dropping, and options prices in general are going to be dropping. But how exactly does that help us determine when should we buy and sell options? So when implied volatility is higher, that is going to make option prices higher, and that's going to be better for option sellers to get into the trade because you're going to have more premium. If you want to buy options when implied volatility is higher, that's going to be a lot riskier because you're paying more for something that's not worth as that much. And I hope that makes sense. And if you guys go ahead and watch how implied volatility affects and IV crush, you guys will get a better sense of what I'm talking about. But vice versa, when implied volatility is low, it's not in the option seller best interest to sell because you're getting a really low price. However, if you're an option buyer, that is a really good opportunity for you to buy options because implied volatility might start rising, and that is going to make your option position rise even if the stock isn't moving that much in your favor. And so that's pretty much it for this video. I hope I helped you guys gain a little bit more of a better understanding of how options work. And in next video, I will be explaining more about what causes an option price to fluctuate and going into details, explaining the Greeks and all of that stuff. So thank you guys for watching. I hope you guys enjoyed it, and I will see you guys in the next one.